Hi, IBD. I'm Meredith Heyman. This is Industry Insights. Thanks so much for joining me. Tesla's third quarter earnings, a surprise miss, with profits taking a steep plunge after the company cut car prices to increase sales. But CEO Elon Musk told investors he wants to be back in the driver's seat and emphasized the EV maker's focus on its autonomous future. Joining me to discuss is CFRA equity analyst Garrett Nelson. Garrett, thanks so much for joining me.
Thanks for having me.
Absolutely. All right, let's get right into it. Tesla reported its third quarter earnings. Earnings were worse than expected. They beat on revenue, but this was due to a 37% slide in net income. What contributed to this performance?
So if you look at the results, their operating results actually were better than expectations. They beat on the top line, as you noted, and their margins came in ahead of expectations. So it wasn't what we would call a really ugly miss. The miss was really due to a much higher than expected tax rate, which caused the pretty significant bottom line shortfall. The tax rate for the quarter was close to 30%, which is much higher than normal. So all in all, the results weren't bad. Our concern is mainly going forward, what EV demand is going to look like in the US in an environment where, as we know, the federal EV tax credit expired at the end of September. And that's the primary reason, in our view, why Tesla posted record vehicle sales volume in the third quarter, close to just under 500,000 units sold. But we really have concerns regarding what their sales are going to look like starting this quarter.
Tesla sold more cars in Q3 than in the same period in the previous year. So tell me more. Why did profits suffer?
It was really just that higher than expected tax rate. They have had higher R&D costs. One of our biggest issues with the story has just been the lack of innovation really over the last 5 years. They've only had one new vehicle model, which has been the Cybertruck, since they made first deliveries of the Model Y in March of 2020. So it's been 5.5 years now since they've had any new model aside from the Cybertruck. And I think that's why you're really seeing their sales, start to suffer. Tesla's sales will be down almost for sure year over year in 2025, and they're losing market share in the US, in Europe, and in China, which is by far the largest global EV market. So that's really, our big concern surrounding the story. Of course, they've been spending a lot of time developing and improving their autonomous driving software, full self-driving, and developing products of the future, such as the Optimus robot and the Cybercab. So, they've made some promises as far as what's coming in terms of future products. Our issue is really just the lack of visibility, and somewhat lack of confidence that they're going to be able to bring some of these products to market as soon as they say.
Tell me more. How did the impact on tariffs affect the most recent earnings report?
Really, Tesla has been less affected by tariffs than other automakers. In fact, one of the least affected if you look at the US-based automakers, because they have three global production hubs. They have the factory in Shanghai in China, which is really responsible for all their sales in the Asia region. They have the Berlin factory, which serves Europe, and then they have the two factories here in the US in Austin, and then the Fremont, California factory. So, because they've largely regionalized, and these are very, very large plants on all three continents, that has really helped them mitigate the impact of tariffs. There has been some effect, but if you look at other US automakers like GM or Ford or Stellantis, Tesla hasn't had nearly the negative impact from tariffs as those companies.
All right, and now let's look ahead. What's CEO Elon Musk's focus for the fourth quarter?
Tesla, we consider it a story stock. It's always, okay, what's next in this story? I think the genius of the company over the last couple of years, Elon Musk has kept investors focused on products that might be 5 or 10 years down the line, keeping investors focused on what the company might look like in the future, as opposed to the real headwinds that they are facing. If you look, Tesla's earnings through the first 9 months of this year have been down 31% year over year. They've really hit a speed bump in terms of the, fundamentals, which just aren't great right now. And it's really focused on continuing to develop autonomous vehicles. We do think they have significant competitive advantage if you look at the technology and the approach that they're taking to developing autonomous vehicles over, say, Waymo. Their more LiDAR faced or focused approach. Tesla's taking a different approach, and we think it will prove to be the right one over time. Our issue is more with the near term, and really all eyes are on this November 6th annual meeting, in which shareholders will vote on this proposed compensation plan up to $1 trillion pay package for Elon Musk. He continues to get paid no salary, but it is a incentive-based program where he could potentially be paid up to close to $1 trillion if he meets the 10 thresholds that have been outlined in that. And so I think they have a battle on their hands because the proxy advisory services such as ISS and Glass Lewis have come out against that proposal and recommending shareholders vote against it. What we know is that over time, Tesla shareholders have consistently voted in line with the recommendations of the Tesla board. The Tesla board, of course, is recommending that shareholders vote for this compensation plan.
And what do you think the likelihood of that pay package passing is?
We think it will pass. If you look back at last year's annual meeting, there was a vote on the 2018 pay package, which had been voided by a Delaware judge.
Hmm.
And so Tesla, put that pay package to a vote once again. Shareholders approve it by a margin of 72%. So we think that this pay package will be approved. It won't be as high as 72%, but it will be above the 50% required to pass. The attitude of Tesla shareholders is that Elon Musk has delivered for them over time. If you've been a shareholder over the last 5 or 10 years, you've done very well with your Tesla investment. So they have a lot of faith in Elon Musk. And on the conference call last week, management Musk was very concerned about this and made extensive comments, very critical of the proxy advisory services, and essentially saying, "We know what we're doing. Please continue to have faith in me as I guide this company, in the coming years."
Absolutely. Now, speaking of how he's guiding the company, let's talk more about Tesla's Robotaxi ride-hailing service and how that is continuing to expand.
So it's growing from market to market. You saw the rollout a few months ago in Austin, has since expanded to certain areas of California. But I think the rollout is going slower than expected. Tesla is being cautious. There's just so much liability associated with this. And in our view, the software, while is very impressive, what they've been able to accomplish and what the full self-driving software is capable of, it's not quite ready for prime time. I mean, it has to be 99.99999% safe. And there's certain instances, and you can look at any number of YouTube videos where it encounters construction zones or other obstacles that it's just not quite ready for full driverless prime time. It's going to continue to be a little bit slower than what Musk is guiding for in terms of how quickly this will be rolled out to other geographies.
And what's the latest news on the Optimus robot rollout and manufacturing issues we're hearing about?
Yeah, not a lot that they're reporting on that. It's another product where we've seen significant improvement in the capabilities. Again, you can look at any number of videos out there as far as what the initial prototypes were capable of and the actions that they were able to perform, even going back a year to their investor day that they held last October, compared to newer updates, newer versions of Optimus. So there's been big improvement. There hasn't been a lot of information, I think, on the conference call with the public comments and in the filings, the things that they've said. There's just not a ton of information regarding Optimus yet. And I think they're more focused on the cyber cab and other products, continuing to improve full self-driving. The other initiatives that they have, where I think the Optimus is sort of on the back burner in terms of when it might actually debut and be available for purchase by consumers and businesses.
But it seems like expectations for future businesses like self-driving taxis, the humanoid robots, are really driving Tesla's valuation more than sales and profit measures. Do you agree with this assessment, Garrett? And how does that impact investors' ability to gauge Tesla's performance?
No, I think that's exactly right. The focus is what the company might look like 5 to 10 years from now, and the tangible addressable market of each of these products and the new verticals that they're entering into. What we know is that Tesla stands out from a valuation perspective. It always has. It's an outlier. You can't compare it to other traditional automakers who largely trade at single digit type PE ratios. Tesla is currently, at least on our 2026 earnings estimate, trading north of 250 times our EPS estimate for next year, and had gotten to a point where, in our view, the risk reward of the shares was just no longer favorable. We've been a long-term bull on Tesla and on the Tesla story, but it had gotten to the point where there was such a disconnect between the company's earnings and the near-term visibility of earnings growth combined with the performance of the shares, which had more than doubled from the lows in April. That caused us to take our rating to a sell in mid-September. So that's where we are right now. The multiples really reflect really euphoria, extreme amount of bullishness surrounding the earnings growth potential over the next decade or so. We do like the fact that Tesla is largely focused on the industries of the future. That is being fully reflected in the multiples at which it trades. And we see other companies, other stocks in our coverage universe that have a much more favorable risk reward currently. And so those are the companies that we are recommending. And we're largely bearish on the EV manufacturers. We have a sell on Tesla, as I mentioned, but Rivian as well. And then we have strong sells on Lucid and Polestar. So those are the four pure play EV manufacturers that I cover.
Tesla's EV China sales are showing a little pep, but they're still down on the year and they're still fairly weak for Europe. What do these numbers mean for investors?
Yeah, these numbers mean that Tesla has continued to lose market share in China and in Europe. And China is really the important one because that market is 3 times bigger as big as Europe in terms of EV sales volumes. Tesla has had a little bit of an uptick in sales in the last few months, but bigger picture, if you go back to 2023, Tesla ranked as the second largest EV seller in China in terms of sales volume. They've slipped in that time to more recently to number five. And China is just an extremely competitive EV market. You have so many smaller domestic EV manufacturers which have been picking up market share. You have BYD, the largest, then you have Geely, which is another very large EV manufacturers, but you have companies like Wuling, Chang'an, Li Auto, NIO, Great Wall, well over a dozen smaller EV manufacturers, most of which have been gaining market share. And so Tesla has been losing market share while they still have the best-selling EV model in China, which is the Model Y. They're really suffering from the fact that they just don't have the variety of number of EV models as some of these other companies. It's been a big headwind for Tesla, and I think they're going to continue to struggle just given the competitiveness of the landscape over in China.
There have been recently the first deliveries of Tesla's Chinese-made EVs to India came last month. How does that play into everything?
There's a lot of potential of growing their sales from that Shanghai factory to these other markets in Asia. It should help. The problem is just really, in our view, Tesla's lack of innovation. Really, the only two models they're selling in China right now are the Model Y and the Model 3, and they just don't have the variety over in that market. Looking at the other markets, Europe is a very competitive EV market as well. And then in the US, we think there's going to be a very significant sales slump with the expiration of the federal EV tax credit. In China, if you look at BYD, now far and away the largest in terms of electric sales, they're selling both battery EVs and plug-in hybrids. They sold about 3.7 million vehicles last year. 60% of those were plug-in hybrids, and only 40% were battery EVs. Tesla does not have a plug-in hybrid product, and for a long time we've been saying that might be something they should look at. There's tremendous demand right now for hybrids and hybrid growth, and in a lot of markets, such as the US, hybrid sales growth is far surpassing the growth rates of battery EVs.
And if self-driving doesn't really get into gear anytime soon, can Tesla EV sales rebound in 2026 after 2 straight years of annual declines?
We're currently modeling that they do experience a little bit of a rebound, but nothing dramatic. And it goes back to that product pipeline. It's hard to imagine what's really going to drive sales volume growth between this year and next year. We know that Tesla came into this year. Initially, they were guiding for roughly 30% growth in volumes. And now it looks like, they're probably going to be down ballpark anywhere from 10 to 15% is kind of what we're expecting in terms of sales volume decline year over year over 2024. So it's really hard to imagine, what's going to drive increased sales. Aside from the Cyber Cab, which they expect to achieve first production of next year, but like has been the case with a lot of Tesla vehicles in the past, they don't exactly have a good track record of bringing these new models to market on schedule. And so we wouldn't be surprised to see some delays in these products that they're guiding for both next year and beyond.
Now, and Musk's focus has really been on the self-driving and the robotics businesses, but Tesla Energy is showing a lot of strength for the company. Why is this unit so important to Tesla?
Yeah, it really goes to the energy storage products. And that was probably the biggest bright spot of Tesla's Q3 earnings was the growth in specifically the energy storage, where I think revenue was up over 40% year over year. They had a record number of deployments during the quarter for the energy storage business. If you look at the segment performance overall, it's really helped offset weakness on the auto side of the business. And so we are bullish on Tesla's prospects for those non-automotive businesses. On the auto side, once they're able to shift to more of a software sales model in getting people to see the value of a full self-driving subscription, they become more of a high margin software seller and less of a low margin auto manufacturer, which is an inherently low margin business, is auto manufacturing, and also have increased diversification with a lot of these non-automotive businesses. And that is going to be very accretive to their margins long term.
All right, Garrett, and finally, one last question, just going back to the autos. Tesla has some new, cheaper models out. Is there a risk that they could cut into the sales of Tesla's more premium vehicles?
So this is the announcement in early October, and there was a lot of excitement when they came out when they made the social media post about this. Prompted a lot of speculation. Oh, are they going to come out with the Roadster, which is another model that they promised many years ago? That I think there's a lot of investor and consumer interest in new models such as that, and I think it was a big disappointment seeing what they announced, which was more baseline vehicles, versions of the Model 3 and the Model Y that have lower range and just have lower capability compared to some of the other variants of the Model 3 and the Model Y. So I think that announcement was a big disappointment. You saw it in the reaction of the stock price following that announcement after, a bit of a pop of the hope that they might announce a new model. So these lower price variants will help to offset some of the decline from the expiration of the EV tax credit. But you had such a pull forward in sales and pull forward in demand in the third quarter. That's why you saw a record sales total for Tesla. That we just think it's just going to be a partial offset, and it's really not going to move the needle tremendously. You're still going to have a pretty big step down in their US EV sales starting in the fourth quarter. And the company really needs some of these new models to really get consumers excited about the company's vehicle portfolio again.
All right, Garrett, a lot of mileage, and we will certainly be watching the road ahead for Tesla. And with that, I'm done with my puns. Thank you so much for joining me. This is Industry Insights. I'm Meredith Heyman. Stay right here on IBD for more. We'll see you next time.